Welcome. Today's Thursday, January 5th. Happy New Year. I'm Jeff Huge, Chief Investment Officer at JWH Investment Partners and the founder of Alpha Insights, and this is your Daily 5. Wanted to just highlight our investment newsletter. We do publish an investment newsletter every single month. The most recent edition was published on the last day of the year, December 31st. This was our 2023 year ahead forecast edition. And we'd encourage everyone watching this video to, go to our website at jwhinvestment.com and go to the newsletter section on the menu tab. And you can read this newsletter for free. If it's not being delivered to you right now, you can subscribe to have it delivered to your inbox. We publish via email the first Saturday of each month, pretty much. The newsletter is affectionately titled Huge Insights, the Big Picture. And we go through a lot of the key macro factors affecting the global economy and the markets, of course. And we usually end with our forecast. We do offer an optional paid subscription for those who want a little bit more. It's very reasonably priced. And, we've got a lot of subscribers. So you may enjoy that. Paid subscribers actually receive our weekly Alpha Insights Idea Generator Lab publication. This is an institutional publication that normally goes to our kind of core research subscribers in our Alpha Insights division. And it really details our top actionable trade idea each week. So if you're looking for, idea flow or just, good ideas or want to make some money trading, this might be an opportunity for you. With that, I'd like to jump into today's presentation with chart number 1. We're going to walk through the bear case. We've been accused of being perma-bears. We're actually not at all. We were very bullish in 2021. We turned bearish in January of 2022 with the market. And if the market defies our expectations and moves higher, we will turn bullish again. Trust us on that. But the main reason that we're bearish right now, and there's 5 of them to be precise, we're going to start with number 1, the restrictive policy agenda being promulgated by the Federal Reserve right now is the main issue. And monetary policy, the monetary and policy environment has shifted from historically accommodative for the last 13 years prior to 2022 to now restrictive. And so far, the Fed has hiked their Fed funds rate by 450 basis points over the past 9 months. And they are likely to keep going until rates hit at least 5.25%. So they say. We actually heard from Neil Kashkari, who's now a voting member in 2023, that he believes rates should go to 540. So, while we're currently experiencing the most severe interest rate cycle in the last 4 decades in terms not just only of time, but magnitude, we've raised rates more than we have at any other point in the last 40 years at the fastest rate. And so that is the big issue. Now, in addition to that, we've seen the real money supply contract by 6.6% year over year through the November data point. And that's actually the largest year over year decline on record, going all the way back to 1959 at the inception of the data. The point is that while the Fed remains restrictive, what worked in the past probably won't work going forward. So if you think you're buying Apple, Google, Amazon, Microsoft are the best ideas, I think that you're probably wrong with that. I think that those stocks will not fare well in a restrictive environment. And indeed, these conditions appear poised to tip the economy into recession. So let's look at chart number 2 to figure out why. The best recession indicator is the yield curve. My old friend Harley Bassman recently wrote, by the way, he's the creator of the MOVE index. That's the volatility index for interest rates. He said, it's a stone cold fact that the yield curve is the best predictor of a recession. And presently, the spreads between both the 3-month 10-year and the 2-year 10-year U.S. Treasury yields are now deeply inverted. And an inverted yield curve has preceded every recession over the past 50 years. That being said, while the yield curve has a perfect track record of predicting recessions, they tend to be They tend to have followed with very long and variable lags, and those lags have ranged between 10 and 33 months. Normally, a recession will begin as the yield curve starts to re-steepen, and we think the re-steepening will begin this year. Chart number 3. Every recession going back to 1920 has been accompanied by an earnings drawdown or an earnings recession. And according to research that was recently published by Lance Roberts of Real Investment Advice, the average earnings decline during these periods has been about 30.8%. I've seen other data by D.A. Davidson going back to 1957, which is the current S&P 500 index data line, that suggests the average drawdown's about 29.5%, so very consistent. Now, if we look at current consensus estimates according to IBIS for S&P operating earnings for 2022 and 2023, remember, fourth quarter 2022 operating earnings are going to begin being reported in about a week. So, we haven't even got the full year for 2022 in yet. But those estimates are currently 219.8 and 229.5. So 220 and 230 respectively for 2022 and 2023. Now, if 2023 S&P operating earnings instead were to decline by just half the average recessionary EPS drawdown, the actual result for 2023 would be closer to $186. That's 20% below the current consensus estimate. I do not believe that that is priced in. And in fact, if the odds are shifting in favor of a recession this year, and we think they are, then valuations will truly begin to matter quite soon. Chart number 4. Valuations today remain extreme. In fact, I just had a conversation with my good friend Doug Ramsey at the Luthold Group, and I said, based on your models, where are valuations in the very long-term history? They're in the top 90th percentile right now, looking back at the entire history of the stock market. And that means that 90% of the time, valuations were cheaper than they are today. So you're paying, the top decile basically of valuations. This is despite a 20% decline in the broad market. So let's just put that in perspective. U.S. total market cap to GDP closed the year at 146.6%. That is below the all-time record extreme, which was achieved earlier last year. But it's still above the prior secular peak of 142.9%. That was recorded in March of 2000 at the height of the dot-com bubble. If we look at Shiller's cyclically adjusted PE ratio, the CAPE ratio, if you will, that closed the year at 27.8 times. Now, that is lower than its recent cycle high of 38.6 times and well below the 44 times at the dot-com peak, but it's well above its historical average of 17.3 times. If we look at just the dividend yield on the S&P, going all the way back to the inception of S&P data, we're looking at 1.71%. That's plumbing its historical lows. 90% of the time during the history of the stock market, you got a higher yield for owning stocks. If we look at price to sales, still bloated at 2.3 times. It peaked at 2.2 times, or 2.1 times rather, at the height of the dot-com bubble. Now we're down from the 3 times that we were earlier this year, but still very, very expensive. And price to book is about 3.8 times. That's below the peak of 5 times during the dot-com bubble, but well above the 2009 trough of 1.7. So, I think it's fair to say, at the very least, it does not appear that the market is pricing in an imminent recession this year. Chart number 5. This is what we've been looking at in terms of the stock market. 2 perspectives. On the left, our cycle degree perspective. This is a 13-year chart looking back to 2009. That's off the 2009 lows. And we're calling this entire advance into the 2022 high cycle wave 5 of super cycle wave 3. So it terminated on January 4th a year ago. And since that time, we've declined a total of 27.5%. And the first decline, the first wave of that decline occurred in 5 waves. We're calling that primary wave 1 down. And the counter trend advance that carried into the August 16th high, we're calling that primary wave 2 up. This is all of a cycle wave decline, which will be a part of a corrective decline, an ABC, which we think could carry the market considerably lower. We're looking for a full retrace of at least 50% of the entire 90-year advance, the super cycle advance off the 1932 low. But even if we got, say, a 61.8% retracement of just cycle wave 5, we're talking about a decline into the S&P 2250 area. But at this point, we think it's pretty fair to say, looking at our primary degree analysis on the right, that we are in the midst of a third wave decline. And what I mean by that is we're in the midst of primary wave 3 down and intermediate wave 3 down. Those two third wave declines should propel the market very rapidly down to our near-term target of around 2750 to 2400. That's a range that we think primary wave 3 down will terminate before we get the next significant counter trend advance, which we think is more likely to be a lateral move. Let's look at the next chart. This is a short-term perspective, 5B, and we'll just wrap it up here quickly. This is intermediate degree of trend. We're really looking at everything that's occurred since the August 16th high, and we think the advance off of that October 13th low, the very choppy overlapping advance, was a counter trend advance. Those are characteristics of the counter trend advance, and the breakdown that we saw recently looks to us to be the beginning of a new leg down. So, in our view, the counter trend advance in the S&P most likely topped at S&P 4100 to end intermediate wave 2. And so the subsequent decline has been tracing out really just the early subdivisions of intermediate wave 3 down, of primary wave 3 down. And we think a move below 3764 would confirm that. Now, if in fact the market does pop back above that 3889 level, which has kind of been the upper bracket for the last 13 days, a Fibonacci 13 days, we've traded in a 125 handle range between 3889 and 3764. A break above that 3889 would probably suggest that the market wants to fill the gap at 3995. But a break below the low end of that range, that 3764, would suggest that the market is now pursuing the next leg down. So that's all we wanted to share with you today. If you want to get more information, you are welcome to check out our website at jwhinvestment.com and definitely take a look at our free newsletter. You can also follow us on Twitter at alpha_insights. We're on LinkedIn as well. And with that, I want to wish you all a happy new year and good luck trading. And as always, thanks for watching.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.